Hello and welcome to In Plain Sight, a TradingHub podcast. I'm Andrew Waters. I'm very happy to be joined by my colleagues Mike Coates and Shane Gannison. Very good to see you guys. So today is going to be a bit of a follow-up podcast episode. So in the previous podcast, we went through the recent interim order from SEBI against Jane Street related to potential manipulation in the Indian stock market and options market. And I think there we really went through, the facts of the case, what was being alleged in the order. But in this one, we kind of are pivoting and we've done some recent data analysis, really kind of digging into the information that was provided by SEBI. I think we were kind of all happy to see that they really provided a wealth of information as part of that order, including trading information, as long as their own analysis of what happened there. So this one is going to be a little bit more focused around that data analysis and specifically kind of asking some questions of you, Mike, because you're kind of the chief architect of that analysis. And obviously Shane and I have kind of gone through that, but I think both had a few questions that we wanted to kind of look at as part of that analysis. So kind of to start off, this probably looks familiar to anyone who has looked at the SEBI order, the graphs that they were provided there, which I think when we often speak with regulators, one of the things we often say is the more information, the better. If these enforcement actions are really the regulator setting out what they believe is manipulative activity, and banks should be using that as an example of what not to do, the more information they can provide, I think, is helpful for everybody in the industry in terms of then understanding what that activity was and then why the regulator found it to be an issue. So, this chart here, I think, is definitely not short on data. I think the issue I had maybe was it was a bit hard to follow in terms of what exactly is happening, what's happening in the market, what's Jane Street doing. How could one kind of compare your own activity to what you're seeing here? I think that, Mike, I don't want to speak for you, but I think that was kind of your view too, and somewhat the driver of doing a bit of a deep dive into some of the data that SEBI provided.
Oh, yeah, I think that's right, Andrew. So, I looked at this graph like everyone did, and it's got loads of really good information on it, like what is their open position in options, for instance, what transactions are they doing in options, single stock futures, index futures. But you can't really get a good feel for the payoff that they're constructing. Like, options aren't trades which can be explained just by being long or short. They're not like buying or selling a stock. You need to know the strike, and you really want to get a feel for what payoff are they constructing via their option strategy. And so in the SEBI order, they spent a lot of time on the day of biggest profit, the 17th of January, which actually was a day which was quite easy to understand because their option strategy was the simplest on that day. But even then, I found these graphs didn't really help me articulate what Jane Street's actual strategy was, why they might have been doing those trades. And so when we got the data dump from SEBI, exactly as you said, we kind of did a whole load of work to actually reconstruct the aggregated payoff that Jane Street had constructed. And then we thought quite hard about how we would visualize it. And so if we leave this chart now and move on to the next chart, you can see the 17th of January using the TradingHub visualization. And I think hopefully you can see a lot more information in this graph. So just to introduce what we're looking at. So the main block, that big kind of beautiful rainbow section in the middle, that represents going from left to right, both the level of the index during the day, which is the Bank Nifty index. And that's drawn out as that purple line. And then we have the payoff that Jane Street has constructed, demonstrated by these contour lines. So essentially, the darker the blue color, the more profits that Jane Street is enjoying from the index being in that territory. And the darker red the color, the more losses they would be making. So you can see that generally speaking here, if the index goes down, it's moving towards blue. And if it goes up, it's moving towards red. It's a kind of an outright short position that Jane Street have constructed. And we can see that, the darkest blue territory, that represents profits for Jane Street, I think, of about $100 million, right? So it's 10,000 rupees or something. And the darkest red would be losses of $100 million.
And Mike, sorry, just to construct this graph, the information you got from the appendix, didn't you, in the interim order? Like, what additional characteristics? Was it just the strike? I mean, what did you need to visualize things this way beyond what was in the 105-page kind of PDF document?
Yeah, so SEBI gave us, or in fact just released to the market, a rich data dump, of 20 days of trading activity. And in that, they produce minute-by-minute aggregated options positions. So in fact, this is a slight simplification. It doesn't include the cash or single stock future exposures that they were building up during the course of the day. But those are de minimis compared to the open index positions created via their options trading. And so, and you can see that too in the SEBI order about where the profits and losses arose from. And so this basically gets the gist of their trading strategy. Yeah. So we did this not just for the main day in question, the 17th of January, which was the first and leading day in the 105-page order. We did it for all 20 days.
And this is so as you said, 17th of January, which is the main subject of the order. Jane Street are short market. They're wanting things to go down. It looks like that is what happened on the day. It looks like they made a little bit of money on this day. But you mentioned on the other 20 days.
It's like
$100 million.
$70 million, I think. Yeah,
70 million. Yeah. So a good day for them. But what? Sorry, go ahead.
No, I was just going to say just some other things just to point out because it's really important to see that the contour lines aren't static. Jane Street are entering into and exiting out of option positions during the course of the day, right? And so the contour lines are evolving. And what you see is actually at the beginning of the day, the contour lines are actually really far apart. So largely speaking, Jane Street enter the day with broadly a flat market risk exposure via options. They then rapidly put on a short position, and that short position's kind of established by about 11 a.m. completely. So, the contour lines have come as close as they're going to come together by about 11 a.m. They've, really put on the maximum market outright directional position. And then largely speaking, they keep that position on until towards the close. They start to unwind it. And you can see that, especially at the top of the graph, you can see the contour lines starting to get further apart again. So it's definitely not the case that they're just entering into the day with a position that's just moving in their favor. They are actively trading in the day. And you can see that because the contour lines aren't just horizontal. And underneath that, we've overlaid the relevant kind of market activity in the related non-options trading. So, in the index futures, in the cash markets, and in the single stock futures, because these markets are where SEBI is alleging that Jane Street's manipulation occurred. So, for this day on the 17th of January, broadly, SEBI make two allegations against Jane Street. They say that when they were putting on their big short position in the options markets, when they were constructing those contour lines, they were benefiting from an elevated index level, which they had created by buying cash and single stock futures. And we can see those kind of green bars in the cash and single stock futures markets at the same time as that contour lines are kind of being established. And then towards the close, the allegation is that they started dumping index cash and single stock futures positions in order to make sure that the close ended the day as bearish as possible to benefit as much of their options position that they built as they could.
And I think, and you can definitely, this is the phase 1 and phase 2 that they were talking about in the order. And I think January 17th was discussed at length in the order. And actually, when you look at a lot of third-party analysis of what this interim order contains, people also focus on the 17th because that's where, that's described in great detail in the kind of PDF document. You mentioned the other 20 days. I mean, how typical was this kind of activity for the other days you looked at?
Well, so the magnitude of the position taking is pretty similar across many of the days. They are huge market participants. The strategies are different. And just before I go and show you what the kind of the four major strategies we see, just to remind everyone that this abuse or this alleged abuse and all of the trading that we're going to be looking at is occurring on the day of the option expiry. And what that means is as soon as you get to the right-hand side of that graph, actually all of the contour lines automatically disappear, right? Let's just remember that you get exited from your positions with zero transaction costs because they all just cash settle. And so, were we to go to the next day, the 18th of January, you would start the day with a perfectly flat terrain, if you like. There is no market exposure via your options because all of your weekly options have cash settled on the 17th in this example. But your question, Shane, about the different, the degree to which the 17th of January is typical is a really good one. So we looked at all 20 days and we largely saw, actually, for the most part, Jane Street was not trading huge directional positions. They were normally doing volatility strategies, and more often than not, actually, they look like the top of these graphs. So just to remind everyone what we're looking at the payoff that Jane Street would enjoy, based upon where the index closes. Blue means that they would be in the money. Red means that they'd have been loss-making. And the top graph shows a volatility strategy where essentially Jane Street is hoping that the index will be largely range-bound and that it will end the day tightly within that kind of narrow, profitable band, right? So
this is a short volatility strategy at the top.
Is a short volatility strategy. Yeah. So, they are benefiting from and betting that the market won't move too much, it won't bounce around too much. And, I think the exact shape that we're seeing, this kind of mountain, that's kind of a short straddle. That's what a trader would call this strategy, normally constructed by selling puts and calls at the same strike. We also saw, I think, only one occasion where they did the opposite of a short straddle, where they were just betting on volatility. So, a long straddle, and we see that in the bottom graph. So there was a day where they were betting the other way around on volatility, essentially betting that the markets would move far away from where they opened, not being specific on direction, just on distance and volatility.
Yeah. And so just so I understand here, you're saying the top graph was much more prevalent than the bottom graph.
Yeah, so I think out of the days that we saw, nearly 2/3 of them were short straddles.
Okay.
And, like 5% of them were long straddles. Now, the remainder were either slightly indeterminate strategies or they were outright directionals. So, you can construct using options payoffs which are very similar just to being long or short the underlying index. In fact, identical. That's the definition of put-call parity. And so you can construct, like we saw on the 17th of January, just a naked short bet. So the blue area at the bottom of the graph and the red area at the top. And you can also do the inverse, bet that the market will go up. And we did see both of those behaviors. So about, roughly speaking, I think about 25% of the time, Jane Street are making directional plays. But most of the time, they're making volatility plays. Which makes, in fact, the 17th of January day that SEBI chose to focus their order about slightly unusual. I mean, nothing suspicious in that at all. It's just not representative of the majority of the days that Jane Street were trading. And I think on the next slide, we just we show every single day as kind of, I hope you've got good eyesight, but every single day here is a really zoomed out version of the payoff constructed. And so you can see of the 20 days, 12 of them were short straddles, one was a long straddle. We had 2 which were maybe slightly indeterminate. We had 1 which was a directional long and 4 which were directional short. So by far the most common strategy was to bet on low volatility.
Because to me, it seems like the Indian options market is known as being extremely liquid and I'd say relatively volatile. So I don't know. My guess going into it wouldn't be necessarily that they would be trying to consistently construct a short volatility straddle position. But I don't know, Mike, if you had, does it make sense to you as to kind of why they would opt for that strategy more often, or that's just kind of what made the most money?
Yeah, so it's a good question. So in their order, actually, SEBI spent a lot of time giving underlying background information about the Indian market, and they pointed out a few things, didn't they? They said, look, number one, options are far more liquid than the underlying indexes and single stocks and single stock futures. And the reason that they put forward for this was that options were a really effective way for retail investors to take short-term leveraged positions. So, there's clearly great appetite in India among the broader population to trade options in order to get short-term leveraged exposure to the market. And if that's true, then those people are all buying options, right? The way that you can provide yourself with a limited downside and unlimited upside, and therefore to gain leverage via your trades, is to buy options. It's never to sell options. So there is an argument which says that you have a structural imbalance in supply and demand for volatility in India, right? You've got these vast swathes of retail investors who every day are buying options. They're therefore kind of bidding volatility, if you like. They may not be thinking about that way. They may be thinking, I like trading options because they're a cheap way to get leverage. But essentially, by bidding up buying options, they are creating greater implied volatility. And a very smart hedge fund might look at that and say, because of that structural flow, volatility is mispriced in India. People are prepared to pay more for an option than they should do, right? And therefore, there might be a systematic strategy where you sell volatility, you put on short straddle positions, and you delta hedge them. And on average, you might expect to make money because the market's being inefficient, essentially, because the Indian retail investors aren't really thinking about the true level of volatility. They're just trading these things for leverage.
And I think, that's obviously a good summary of kind of what we saw and patterns across the entire time. But slightly going back to what we were discussing before too, the volumes when we were kind of looking at it in terms of the activity in the options market versus the cash market, even the index derivatives, single stock futures. I mean, the volumes in the options market kind of vastly outweighed the other markets. I think when you were kind of sharing some of this analysis, this jumped out to me too. So I think this is kind of some analysis you did kind of looking at that pricing in terms of, more normal market convention would be that the pricing is going to come from the cash products because the derivatives are then priced off the cash products. But given the, kind of volumes traded in the derivatives market, I don't know, it seems, I think from, your analysis, maybe we didn't quite see it working out that way, and kind of summarize it a bit.
Yeah, so I think this was something that really jumped off the page to me when I first started thinking about this market. So, SEBI provide us with this information that 350 times the risk trades in the option market as trades in the underlying index. And initially, I wondered, well, how is it possible for people really to make markets in options if the underlying index isn't that liquid? Because, conventionally speaking, option market makers provide liquidity to people who want to net buy or sell options. And then you would expect them to manage, if you end up with an option position, you end up with a dynamic exposure to the underlying, because option payoffs have kind of are curvy, they're not straight lines. And that means that as markets go up and down, you need to access liquidity in the underlying index risk in order to risk manage your evolving exposure, right? So, people talk about this as dynamic delta hedging or gamma trading, but, ultimately, if you're Jane Street, let's say, and you have a strategy of generally selling volatility, then as the markets go up, you're going to need to buy the underlying. And as the markets go down, you're going to need to sell the underlying, right? And that's how you should be, in theory, risk managing your position. So you need access to a liquid underlying market. So to begin with, I was like, well, this makes no sense. How can you have 300x the liquidity in the options? That just means that people aren't delta hedging. I guess I forgot kind of options 101, which is that you can construct synthetic index exposure by buying a call and selling a put at the same strike, and you can actually just create outright delta exposure by trading options themselves. So maybe that's what people were doing. And if that is what people were doing, I started just to question whether or not it really would be the case that people were pricing the options off the very illiquid underlying index market, or whether, given the volume of trading, whether it would be the other way around. Maybe the tail was wagging the dog rather than the dog wagging the tail, so to speak. So I wanted to really test this because it really gets to the nub of half of SEBI's allegation. So SEBI's allegation kind of falls into two parts. One is to do with manipulating the fix, manipulating the close. And one is to do with propping up the market or suppressing the markets in the open when you're putting on your large options position. So, for instance, on the 17th of January, SEBI were alleging that Jane Street were buying the underlying cash markets and linear derivatives markets to push up the price there, so that the wrong kind of reference price would be used, if you like, for the options. Mm-hmm. And so I wanted to test whether that was possible. If that was true, if that really was true, then you would expect that when you're putting on outright delta risk using the options, that the underlying market wouldn't move, right? Because the index is driving the options, not the other way around. And so in order to test this, we did a regression analysis, which is this graph that you've just shown us, Andrew. So essentially, the x-axis on this graph is the amount of outright delta exposure traded in 10 minutes by Jane Street. So the further right you are on that graph, the more delta that they were managing to acquire in the options market from the long perspective. And if you're on the far left of the graph,
this is just 10 minutes at any point, the last 10 minutes.
Oh yeah, just in 10 minutes across all of the 20 days. So there are hundreds of dots on the graph, consequently. And then the y-axis says, during that same period, what happened to the level of the index? Did the index go up or did it go down? Now, if it was the case that you could do a small amount of trades in the underlying index, manipulate the reference levels for the options, and then get size done in the options, you wouldn't expect the index to respond in a predictable way to transactions going through in the options market, right? Because that's kind of the nub of SEBI's allegation about the behavior on the open. But what we do see actually is quite a strong relationship between the amount of the size of the delta that Jane Street is doing in options and the price impact that is correspondingly created in the underlying index. So this graph actually is not random. There is a very strong kind of linear relationship between those dots. And therefore, there is quite a lot of evidence that the principal source of liquidity and price discovery for the index is the options market and not the other way around. And therefore, I think this makes that first part of SEBI's allegation a little bit awkward for them. When we did the same analysis on the smaller amount of index data we had, the actual trades on the underlying index and single stock futures, we actually found a weaker regression.
Where did you? That is, and this is not in the SEBI order, right, Mike? This is something that you have.
So we So we went back to the underlying data dump from SEBI. There's 20 days. In that 20 days, we had minute by minute evolution of the options positions. We could see what the delta associated with these options were, and we could also, so we could use that to construct the x-axis in this graph, and the y-axis we could construct from the index level, the market data. Yeah.
Okay. I think this was the bank Nifty, and then we kind of then formed the same across the Nifty index
the broader
as well.
Nifty index. Yeah. So there was of the 20 days, 3 of them were allegations of market manipulation on bank. Sorry, 17 were bank Nifty, 3 were Nifty. And so, we did the regression analysis on both and saw the same results. So in both occasions, it really looks like the principal source for liquidity for price discovery for the underlying index contract isn't the underlying index future markets, is the option market.
The options are.
And that makes it hard to believe that in the course of normal trading, you can trade a small amount of index futures to manipulate the price of the index futures markets and clear a large amount of index options at the wrong level, from my perspective.
Mm-hmm. Which is the nub of the allegation in phase one.
Correct.
Yeah.
But I guess that also kind of guided our analysis, really focusing on, well, what is the kind of the options payoff look like for Jane Street, and trying to understand their options position, because if they're able to kind of influence where the index is going to settle purely by trading the options, also they're going to, they expire, they're not going to have to worry about any position once it closes. It kind of would make more sense for them to be trading in that market more heavily. And that's kind of where we kind of focus in the heat maps that you created. And kind of jumping back into those, I think there was one day in particular that jumped out to me, because I think throughout the order we kind of regularly see that Jane Street is making $70 million a day, these kind of quite massive sums. But I think it was the 8th of May where it looked like actually from the kind of analysis you performed, Mike, that they would have lost around 4 billion rand, which was
rupees.
Rand, yeah, 4 billion rupees. Getting my currencies mixed up. But within the order, it was obviously SEBI included in the order because they thought this was one of the more profitable days. They were kind of, this alleged scheme was going on. I think they said that they made around 30 million rupees. So I guess maybe kind of wanted to ask you in terms of then when you were kind of digging in, how did this kind of reconcile to the analysis that you were doing?
So this day also jumped out to me. So let's just remind ourselves what we're seeing on the screen. It's Nifty, not Bank Nifty, so the broader index. And actually, what, we haven't introduced these indexes. So very quickly, to give you an idea of the liquidity in India, the broader Nifty index, so the broader index for Indian stocks, has a market cap, I think, of about $2 trillion. And the Bank Nifty, the narrower index, has a market cap of about $500 billion, $500 billion. So
those are
just
12 financial services stocks in India, right? In Bank Nifty.
Yeah. So just to contextualize this between against, I guess, American markets, the S&P 500 has a market cap of nearly 60 trillion. So it's about 30 times as big, as liquid as the Nifty. So 2 trillion market cap, that's kind of similar-ish to Amazon, right? 500 billion, the Bank Nifty, the narrow index, that makes it similar to like MasterCard, just to give you an idea of, when we're talking about taking $70 million in a daily profit from an options strategy, and we're talking about the size of the transactions that Jane Street are doing, it's useful to have those comparisons in mind, I think. So
that's an incredible relative data point, I think. 70 million of something that is 500 million in market cap.
Yeah, 500 billion, but
500 billion, sorry, yeah.
But I think this is just the fact that, increasingly all of the market capitalization in the world is concentrated in the US, right?
So I noticed there's no blue on this.
Yeah, so this is one of the things that struck me as well, and actually made me panic and think that we've done all of our analysis wrong initially. So this is the 8th of May. We see Jane Street constructing their normal short straddle position. So the very small amounts of blue that do exist are very, very light blue, and they're kind of in the middle of this graph. And that implies that their intraday trading has been losing money, and that, they're trying to, hoping that the market lands, I think, in an increasingly narrow strip. Mm-hmm. And then we see that as the day progresses, things look like it's going to be okay. The market's kind of roughly where they want it to be. But then into the close, that central purple line starts to go south, and it starts to enter kind of extremely loss-making territory from the perspective of Jane Street. And so just like you, Andrew, when I looked at this, I was like, wow, so Jane Street lost $40 million on this day. That's what it looks like to me as well. It seems reachy to accuse them of manipulating the market in their favour. What am I missing? And it took me actually a disgustingly long amount of time to remember that these contracts are not actually quite equivalent. So in India, the options contracts that are super popular are the weekly expiry options, right? And they're super popular, among other reasons, because the shorter dated an option is, the less the time value associated with it, and the more leverage the option buyer might enjoy, because they're not having to pay for the time value. And so they are really, really popular. So the position that we're seeing, the contours, they represent the position that Jane Street's built on that weekly option, which will expire today. The horizontal line that we're looking at is for the monthly index feature, which does not expire today, right? There's a basis between these things. When we get to the end of the trading day, tomorrow, those weekly index options will all have been cash settled, but the index feature will keep trading and won't cash settle for, another 3 weeks or something. Now, really, really importantly, when the index options cash settle, the reference price used to determine whether or not they're in the money is not the level of the index feature. It's a kind of a calculation that takes us back to the single stocks. So in this example, in order to work out which option contracts are in the money, we will, at the end of the day, we will calculate for ourselves the index value. We will ignore the index feature and we will calculate the index value by taking the market capitalization weighted average, price of the 50 stocks within Bank Nifty. And more specifically, we will take, for each of those stocks, we will take the volume weighted average price of the trades that occurred in them in the last 30 minutes of the trading day.
Is that normal, Mike? By the way, because the index future is meant to be the aggregate value of its underlying constituents, and it seems strange to then just leapfrog over that. It's almost like a recognition that you don't think the index value is representative of the constituent value.
Well, so the index future is really good. The trader level of that will reflect the balance of supply and demand for people wanting to take that bet, if you like. A future is essentially a bet on something, and in this case, it's where the weighted sum of those stocks will be at the end of the month. Now, obviously, if it deviates from reality too far, then some very smart arbitrageurs will come into the market and they will buy the index and sell the underlying single stock futures, or do the opposite in order to make some free arbitrage profits. And by doing so, they will kind of force these two markets into line. But that arbitrage, that kind of will only be guaranteed to make profits if you can execute it and make not just essentially, the arbitrage profit. You also have to pay for the bid and offer that you have to cross in all of those markets. So there will be some deviation between the theoretical value of the index and where the index trades at any given point in time. People might refer to this as the index basis.
Yeah.
And that will go up and down during the course of the day. It will mainly be range bound, though, because if it deviates too much, then the arbitrage will work and people will put the arbitrage on. So having reminded myself of the existence of this index basis, that actually closes the loop. So it just so happens that on the 8th of May, if there had been no index basis whatsoever, you're right, Andrew, that Jane Street would have lost to about 40 million US due to their kind of failing option strategy. But fortunately for Jane Street, the index basis was such that the index was trading about 120 rupees cheap of the underlying stocks. And when you take that into account, that explains why, in fact, the index options expired kind of flattish from Jane Street's perspective. And to some degree, you can see why that might be the case. Jane Street were extremely active in buying single stock futures in the last 30, 40 minutes of the trading day. During that last 30, 40 minutes, they bought a total of about 50 billion rupees, so about $500 million US in the single stock futures. Now, single stock futures are going to literally be one-for-one correlated with cash. It's not a difficult arbitrage to put on. So that's going to put a lot of upward pressure on the cash markets and, potentially cause the cash market to deviate from the index futures market and create that basis. And just to give you an idea of what that is in terms of participation, that 50 billion or so rupees represented about 30% of the single stock future market during that window. So, Jane Street were big participants in that market at the relevant time. So, looking at this with maybe slightly friendly eyes, you might say, okay, so Jane Street, they put on an option strategy. It seemed like it wasn't successful. The market moved against them, and boy, were they lucky, because in the close, the basis kind of bailed them out.
And with unfriendly eyes.
Well, that's a good question, right? So it did lead me to ask a follow-up question, which was, I wonder if Jane Street are always lucky, or some people are. I think Napoleon said of his generals it was more important that they were lucky than good. Maybe that's true of Jane Street as well. So we looked across all of the days where they were trading bank Nifty options, and for each of those days, we plotted them on this scatter plot. And there's two dimensions to this scatter plot. So the x-axis represents the size of the index basis. And if we're on the left-hand side of the scatter plot, it means the index basis was hurtful for Jane Street, right? As in, were you to look at the index future and see where that closed, the underlying cash market closed in a worse position for Jane Street, and so they lost more money than they might expect. And the inverse is true on the right-hand side. And then the y-axis is actually how much P&L, additional P&L, that index basis contributed to Jane Street. So we see, if we look at all of the 17 days where they had Bank Nifty trading strategies on, apart from one day, the index basis was always in their favor. They were always lucky. And if we widen the analysis and include not just Bank Nifty, but also Nifty days on the next graph, we see that actually, that pattern is just even more compounded. And the dot all the way up in the top right, that represents that one day that we were just looking at, the 8th of May, where, the basis was just spectacularly in their favor. So there's a pattern here, right? It does appear that, maybe by luck, maybe they're making their own luck. It just does appear that in the close, the index basis seems to move in Jane Street's favor from the perspective of their options position. Now, there's one day, and I think, Andrew, you've highlighted it in red. Maybe you want to just tell me why you've done that.
Yeah. Well, I mean, there's one clear outlier here in terms of the P&L, where everything's very much up and to the right, which would, good for Jane Street. But we have this one day that kind of seemed to, be down in the lower left quadrant, which I think prompted us to take a little bit deeper look into what was actually happening on that day.
Right. So, maybe this is going to provide evidence that, Jane, it is luck, right? Maybe if we look at this day in more detail, we're going to discover that actually sometimes Jane Street's trading activity in the close, especially in the underlying market, is hurting their option position. Who knows, right? Maybe. So, I was drawn there too, and we did do the analysis for this day. So this day, I think, is the 19th of June, 2024, back in Bank Nifty. So if we get on to the next slide. So this is the day. Let's just remind ourselves what we're seeing here. So if we look at the contours, we're seeing that this is one of the days where Jane Street just took an outright position, and it's an outright long position that they've constructed via options. So all of the kind of high profitable areas, all those blue areas there at the top, all of the red and orange areas at the bottom. And we see that during the day, the market traded up and kind of looked to settle in this kind of high profit area from Jane Street's perspective. But our analysis on index basis means that we're led to believe that when you came to calculate the settlement value for the options and you went to calculate the actual underlying value of the index, it produced a disappointing P&L from Jane Street's perspective. Essentially, the value of the index calculated by looking at the underlying cash markets was a little bit underneath that purple line of the index futures. So that indeed would be a bit unlucky for Jane Street. So it's interesting to look at what Jane Street were doing in the close on that day in the single stock futures market again, right? And you can see from that graph at the bottom that they were buying super aggressively in the close. So in the last 35 minutes of the trading day, Jane Street was 45% of the markets. It's unbelievable market participation. They bought nearly 100 billion rupees within that last half an hour or so. Now, that is 0.2% of the market cap of Bank Nifty. So to put that in context, I think that is the equivalent of buying 120 billion US of, it can't be right, can it?
The 100 billion, yeah.
No, 100 billion, 120 billion of
Yeah.
S&P 500 futures or something, or S&P
In half an
underlying
hour.
single stock futures in half an hour. So in terms of the amount of liquidity that they are consuming, they are putting in an incredible upward pressure on the single stocks. I can say that on this day, it's definitely true that the single stocks closed cheap of the index, so the index basis was not in their favor. But it's hard to say that it's hard to look at their trading activity and say that they didn't try their best to make the underlying index be in line with the index futures, right? Or the single stock futures.
Wasn't for lack of effort.
Yeah. I mean, if you were to be unkind, I mean, obviously we're not here to pass judgment, but they definitely weren't the cause of the index basis being against them. Maybe that's a safer way of saying it.
Yeah. It's one of those ones where it's going to be interesting to see what it will have looked like without you kind of, rerun the universe and take their trading out of it. Where would it have closed? That's kind of, we can't say exactly what the impact would be, but it's hard to say that it wouldn't have had much of an impact, right? If you're looking at it from that perspective.
Completely agree.
So, Mike, I think you've done a pretty good job over the last, 35, 40 minutes or so. Pretty good. Pretty good. Of explaining
Top crowd.
Always. I've explained the relationship, I think, between the single stock futures, the index futures, and the option positioning. I think we have probably drawn some conclusions around activity in the open being not so concerning, but activity in the close being something we probably want to take a little bit of a closer look at. And you made some points around basis being pushed around or alleged to have been pushed around in particular directions. Was there anything else about position building over the course of the 20 days that jumped out at you?
Such a well-executed, innocent question there, Shane. So I'm glad you asked that question because there was something else about the position building which struck out. So I really wanted to have a proper examination of how Jane Street typically traded, particularly on the days where they were short straddles. Remember, that was like nearly 2/3 of the trading day, something like 12 out of 20. So, I've chosen one day to deep dive on for a few slides, 6th of December 23. It's very typical. So what do we see here? We see the contour lines. They look like the short straddle we're expecting. We can see that the market opens a little bit higher, but it seems to kind of pull towards Jane Street's sweet spot, kind of stays roughly range bound during the day. We see that the position is built kind of in the first 2 hours or so of the trading day. So after about 11 a.m., the contour lines are established and they don't really change that much until we get closer to the close. And then we can also see in the close, heavy activity in the single stock futures market, which potentially might be pushing a beneficial basis, you could argue, right? But I really wanted to start by looking at the position build in a little bit more detail. And, the next few slides, we look at it as it evolves during the course of the day. And the first thing I want us to notice is that Jane Street starts constructing a straddle, and it starts constructing a straddle which is not at the current market mid, right? It is lower than the current market mid. So, I have drawn on the bottom of this slide a graph of, one sub, cross section through the contours, right, which is the cross section at 10 to 10, and this shows us the payoff that Jane Street's constructed, and it also has two vertical dashed lines, one where the market opens and one where the market was at 10 minutes to 10. So you can see that Jane Street starts constructing, it starts basically selling volatility, but not at the money. It sells it at a lower level than at the money, right? Now, this is a little bit odd, because if you are trying to construct a strategy where you're selling vol, you're doing that normally because you believe volatility will be lower than the market thinks it will be, and you want to receive the time value for selling options, right? And you believe that time value will more than compensate you for the cost of dynamically hedging your aggregated payoff. And if that is your strategy, then you're going to get the most time value if you sell at the money vol, right? If you're basically constructing the straddle so it's going to have the maximum payoff at the kind of level where the market opens. That's not what Jane Street does, right? Jane Street constructs, if we look at those contour lines, it's constructing the peak of its payoff substantially south of where the market opens. And we see, if we see that on this slide, and we can think about what that's doing to the market, right? So if you look at the payoff that Jane Street's constructed, and we look at the two dotted lines, the dotted line on the right shows where the market opened, right? So essentially, from a perspective of delta exposure, where the market opens, Jane Street's payoff is kind of looking like a straight line. So their straddle payoff is giving them a bearish position. They will make money if the market goes down, right? Because they're not at the peak of their straddle. And we know that, we know this from our regression analysis. We know that the index level will follow the balance of supply and demand for the index risk that is generated from the options market. We saw that when we did the regression analysis. So, and we should also recognize that in this time that Jane Street's putting on this position, that bearish straddle is creating a lot of delta. That's, 50 billion rupees of delta that they put on. And, from our regression analysis, that implies that it should create a price move of about 70 rupees in the index, right? From that same kind of scatter plot of regression we did. So, Jane Street is putting on a short straddle position, but it's putting it on in a way where actually, at the moment in time where they put it on, it's actually a bearish outright delta position. And to some degree, that is going to have a market impact, which will drive the market down towards its own sweet spot. And then, the next slides, we then look at the evolving payoff, right? So here we're looking at the incremental option payoff that they constructed during the next 35 minutes. The next 35 minutes. And we see, yet again, they're constructing trades, which is giving them, again, more bearish exposure. So another negative 60, 70 billion rupees of delta. Again, this is going to be driving the market down. And then we see in the final 35 minutes or so of their position build that they are still adding on incremental bearish delta by where they're constructing their straddle. So essentially, what we've got to remember is that Jane Street is executing a volatility strategy without delta hedging it, right? So they are they're creating a payoff which will be providing market risk exposure to its counterparts. And if those counterparts are themselves delta hedging, they're going to end up driving the markets in the direction that Jane Street wants. So in a way, if you put on a very, very large short straddle position, and you are a very, very large player in a given market, and if that short straddle position is asymmetric, it's off center, it's not at the money, then it can act like a bit of a tractor beam, which will drag the market towards the peak payoff for the person who's short straddle.
And so this was kind of one day where we saw this analysis, and it looks like, this is kind of, I think even in the SEBI order, they mentioned this period running up to 11 a.m. where Jane Street is really active, and kind of how are they kind of especially constructing their straddle position. I think one thing that jumped out to me then was when you kind of collated this into the next slide, looking at where the kind of peak of their straddle was and then which direction the index moved. I don't think it takes a huge amount of kind of a financial knowledge.
Just to be clear here, just so we're all looking, index open is where the index opened, obviously. The straddle peak is where they executed a peak to the... Sorry, go ahead.
So So look, I think there is a lot of information on this slide, and this is what we're talking about is something which is quite nuanced. So if we just roll back to the previous slide, I think what we're saying is that if we just roll back to the previous slide, Andrew, what I'm saying is that if you construct an option payoff profile as a large market participant, which has the peak of its payoff not at the current market mid, it will potentially act as a tractor beam which drags the market towards it as your market counterparties attempt to absorb the outright market risks that you've taken. And so on the slide that you jumped to, Andrew, the slide, we tried to understand whether or not that this is a pattern that was repeated on the other 12 days where Jane Street was short straddle. So on every single day where Jane Street was a shorter straddle, we've recorded in this table, where did the index open? And then the next column across, we say, where was the peak of the straddle that Jane Street constructed? And we've put an arrow next to it to show our listeners and our viewers whether or not Jane Street essentially wanted the market to go up or down. Had they constructed the peak of their straddle to be bearish or bullish? And then finally, in all of these days, Jane Street had pretty much constructed its short straddle and completed that by 11 a.m. And so we wanted to then look at the next column as whether or not the tractor beam had worked, right? Was it the case that this short straddle, having been created, seemed to correlate with the market being dragged into the sweet spot for Jane Street? So having constructed a short straddle which was, bearish, had that correlated with the index trading down, and when we constructed a short straddle which was bullish, where the peak was kind of going to produce the maximum payoff if the market went up, has that correlated with the market going up? And of those 12 days, we found a 100% correlation. So it either Jane Street kind of just knew which way the market was going to move, in which case I might argue why they didn't just put a directional position on, or the way that they constructed their option strategy and the size that they represented in the markets kind of created enough market impact that it dragged the market, via this tractor beam action into the sweet spot of their straddle, that nice blue landing ground that they wanted the market to be in. And then on this, finally, we talk about the outright option delta that they'd taken and the actual profit that they had kind of materialized by this strategy by 11 a.m.
It's an interesting table, isn't it? Because you could look at this two ways, I think. I think you could look at this as turning, use the word tractor beam, which kind of makes it seem like someone has turned a tractor beam on. You could also look at it the other way, if you were being kind, as, trades have market impact. And if market impact is a byproduct of your trading activity, that's kind of nothing to see there, right? So it's an interesting, you can have two lenses to this, I think.
But if your strategy is essentially designed to potentially benefit from your own market impact, then I think that's when you begin to cross the line, certainly in my mind, into kind of manipulation. So, bear in mind that we're on option expiry day. So you're on this funny day where when you're entering into these large positions, you're creating a market impact. And in the case of this tractor beam, maybe that's dragging the market into your sweet spot. You will not ever need to unwind those positions and by doing so, drive the market the other way and give up all of your gains. You know, everything just disappears at expiry when you're trading all those single stock futures in an uncorrelated way, of course. So it's I think it's more nuanced than just saying, oh, you know, trades to create market impact and potentially nothing to see here. You know, we must remember also the dominant position Jane Street has in this market and almost the obligation to be aware of the market impact they're creating, I think.
No, I mean, I think I'm just playing devil's advocate. I mean, both sides here, right? This is a impartial, non-judgmental
counsel for the defense, of course. Of course.
Exactly. I mean, speaking...
Oh, please, Andrew.
I was going to say, I mean, unless you had anything else on this one, I mean, I'd kind of nice segue into market impact and the section. I think there were two of these days. I think it was the 3rd of Jan and then one of the days in the 13th of September. I remember you took a little bit more of a closer look at like specific time periods there, specifically the amount, just the sheer volume, I think, that was traded during that time period and the potential market impact that had was, I mean, pretty significant from what I recall when we kind of discussed this earlier, but maybe we could kind of touch on the 3rd of January date too.
Yeah, so I think 3rd of January. So I was, you know, having performed this analysis on, so we at this point performed a series of analysis on subsections of the trading day. So we'd looked at the relationship between the underlying index future and single stock future markets at the open and whether or not there was, you know, intraday manipulation so that they could enter positions cheaply. Probably concluded from TradingHub's perspective, that's quite a hard one to prove. We looked at the activity in the close, whether or not it was designed to potentially create favorable basis. We'd looked at the way that they were building extremely large positions and, you know, systematically and, you know, 12 out of 12 times seeming to get success of that. And knowing my powers of 2, like all good computer scientists, I think the chance of that happening by randomly is like 1 in 4,096 or something. But, you know, I was also interested in looking at points in the day which might be interesting where, you know, maybe intraday trading strategies have kind of been observed. So on the 3rd of January, we see exactly that. So I've zoomed in or grayed out the, so we're just focused on, you know, a small window in the late morning, early afternoon. And the first thing is that, you know, just looking at the contour graph, we can see that the contours are changing. They're not flat across this period. So trades are occurring. And we can also see that those, you know, those contours start trading after a large move in the index market. So, you know, the index market has spiked up and we see a whole load of trades occur. And then the index market seems to settle down afterwards. Now, if Jane Street was conducting just a classic short volatility strategy, they would have sold volatility, right? So they're expecting the market to be kind of range bound or whatever. And as the market spikes up, they were wrong and they consequently have to buy the underlying. And as the market spikes down, they have to sell the underlying. And so, you know, the more times they're wrong, the more volatile the market is, they end up giving up their time value that they got paid, you know, for writing the option. So here the market bounces up. So we would expect Jane Street to have to buy if they were kind of conducting normal kind of gamma trading around an option. We look instead at what they're actually doing in the options market and, you know, what outright risk exposure they're creating. And we plot that in the line graph below, right? So we plot the additional option payoff that they constructed during this short window. And we note that rather than buying or creating a long additional position as the markets went up, as you might expect, they've actually put on quite a large short. And that additional short position is what's causing the the gradient of those lines to change. that's quite surprising, right? So, let's look at what was happening, across the day, essentially. So they put on their short straddle. The market is where they want it to be. It's in the middle of their tractor beam, right? Something happens that causes the market to kind of bounce out of their tractor beam. And what they do is they then kind of put on a very large trade, which you could interpret as them slapping the market down in order to push it back where they want it to be in the middle of their tractor beam. And what they are doing is they are trading in size here, right? So, in the middle of the day, they, in that 40-minute window, which we're zoomed in on, they're trading 40 billion rupees of index. Again, let's just compare that, from a market cap percentage. That's, about 0.1% of the market cap of the index. So that is, like doing 50 billion of the S&P 500 over the course of 40 minutes. It's an enormous amount of liquidity that they are, dumping into the market. And it has the consequence, and I think we can see this, or it certainly seems to be correlated with the price getting back onto their kind of landing zone that they want it to be on.
Yeah. Back in the blue.
Back in the blue. So this jumps out at me because, it's one thing to say that I have a strategy about being short vol, but then I might expect you to be managing your intraday delta consistently with that strategy. But here they're behaving completely opposites from that. So maybe their strategy is more sophisticated. I'm not saying that it's automatically their strategy is that they're trying to manipulate the markets, but there's certainly an interpretation where that's what's going on. And then the other, I think we had another couple of days actually where we were just looking at some intraday trading activity here. Just
a little bit
actually,
later
we're still
on
the
the
same
third.
day. Yeah, a little
It's
bit
kind of
later
gone the
on.
other way, right?
Yeah, so to the left here we can see that having put on that big shorts, the market gets back into their landing zone and maybe almost comes too far into their landing zone, and they subsequently put on an incredibly large long position in the next 40 minutes. So they do 100 billion rupees of delta, so 0.2% of the market cap, again in about 40 minutes. So they're kind of doing the opposite of what you'd expect of someone who's delta hedging being short vol. So in this, if you're short vol, you end up buying high and selling low as the market bounces around, because that's what your gamma hedging means that you're obliged to do. Here they seem to be they're almost trading as if they're long vol. They're kind of selling high and buying low. And that kind of is odd in the context of having a short vol strategy. But is maybe consistent with trying to keep the market within a tightly defined landing zone.
Yeah. And I think
oh, sorry, go on, Andrew.
Yeah, as I said, then I think the other day we had was
13th of September, no?
The 13th of September. Again, when we're discussing, I think that's where we saw some of the highest volumes of trades kind of being put on in relatively short time periods. Again, I think over a 2-hour period, right?
Yeah, so this I think I just wanted to include this day just because it really gives you a real feeling for the size of the position taking that Jane Street's responsible for. So, maybe this isn't the day which is, providing the hottest evidence for manipulation or anything like that, but I really just wanted to focus on the absolute size of delta that they are transacting intraday in the index options market. I also want to point out that it seems to strongly correlate with the price going up and going up towards a more blue area of the graph from their perspective. But you're right, Andrew. Over this 120-minute window, Jane Street have constructed about 350 billion rupees of index delta by trading options, and we can see that in the graph on the bottom. That is not far off 1% of the market cap of Bank Nifty, right? So, it's 0.7% of the market cap of Bank Nifty, I think. So, again, I think if we were to think about the S&P 500, if it's worth $60 trillion, 1% is like 600 billion, 0.7% is going to be about 400 billion. So it's like trading, from a liquidity perspective, $400 billion of the S&P 500 in 2 hours.
2 hours.
It's kind of hard to understand why you would do that were it not the case that moving the price was your objective.
Yeah, when we're kind of thinking about the normal definitions around creating an artificial price or impacting normal supply and demand, when you start getting into these type of numbers and volumes, you can see kind of where why these particular days jumped out to SEBI when they were doing this analysis.
Yeah. I mean, look, we should be very careful, be on the record. I can't speak about whether this was part of a manipulative strategy or not. All we have at our disposal is the data that SEBI have shared with us on a subset of the days, presumably, that Jane Street were trading options in India. So these may be cherry picked. The other days may have completely opposite profiles, and when you look at them in aggregate, maybe there's no aggregated signal. But when we look at these days, using the tools that we have available, the things that jump out are the size of Jane Street's position taking in the option market is enormous, and it's highly likely to have significant price impacts on the clearing level of the underlying index and the underlying single stocks and single stock futures. And because that's happening on option expiry dates, there is potential danger there that they are benefiting from their own market impacts in that cash settlement process. There's definitely also very strong danger around conduct in the close. This strong trading signals in the underlying single stocks and single stock future markets, which you could interpret as being designed to manipulate the settlement price calculation. And then, thirdly, the questions around what exactly was the option strategy. One interpretation is the construction of this weird tractor beam with then subsequent trading designed to, knock the market back into it. If it's not that, what is the underlying strategy? At this point, I suppose enough of Jane Street's trades have been released that they probably don't lose anything by just actually trying to explain what the bona fide strategy was that they were executing, if that's going to be their defense.
So I think we are expecting more information here, aren't we? Because Jane Street have been very robust in their pushback to SEBI here, depositing this $500 million or whatever in escrow to maintain access. So I think we should expect in the coming months more details around, strategy, the bona fide strategy, or at least the articulation of what that bona fide strategy was. And we will probably have a follow-up podcast, I imagine, shortly after.
I think we're going to be back, I think, in the not too distant future with a read across to other markets.
US,
I think
that's true.
Yeah, I think you've been doing a bit of broader research compared to my hyper narrow 20 days research.
It is. It's a very good preview into the next podcast, Mike. So I think that's what we're going to be touching on. I've been doing a bit of a look across into some other markets, other products where this again, we're not kind of making a judgment of whether or not this is manipulation or not, but I think where we kind of see similar patterns where you're kind of trading across different products, especially around expiry days for certain derivatives, and where in some of those products there has been some other allegations of potential market manipulation, which I found to be quite interesting. So yeah, good preview into the next episode of In Plain Sight.
When speaking of preview, I'm actually previewing 2026 TradingHub merch, and we normally have Easter eggs in our podcast. So for the first 3 people who make it this far and send us an email, we will send you one of these.
Oh yeah, nice.
2026.
Why don't we instead say that the best 3 continuity breaks brought to our attention by subscribers to our podcast will get a free gilet from Shane, right?
There you go.
You're
this is
ruining
not a
the
gilet,
illusion.
this is sleeves, by the way. This is a quarter zip.
Sleeves. Oh
yeah,
wow, we've really buying a lot more fabric than usual.
Yeah, exactly.
We're ruining the illusion that we just kind of knocked this all out in one go, Mike, with our our continuity mistakes here, pointing them out.
Yeah, I really think we should actually start leaving deliberate continuity breaks in. It could be like,
Different
change of outfits,
Yeah.
stop tossing your hair from the opposite side or something,
Yeah,
right?
exactly. You guys like swap glasses or something. I think that would be good.
Yeah.
Well, thank you guys very much for joining, and yeah, please do keep an eye out for the next episode. But I think that we'll kind of wrap up here on this one, the data analysis of the SEBI order related to the Jane Street activity. Please remember to like and subscribe, and thank you all.